Hi, hello, welcome to all. In this video, we are going to discuss about transfer pricing and other provisions to check avoidance of tax. That is international transactions test your knowledge questions. So, in this first question, what is given in question? I will explain in question and I will explain the answers. What is there in question? Here, there is assessing officer and making adjustment to arm's length price to international transactions of resulting increase of taxable income. So, what are the remedies is available for assessors? So assessing officer is making adjustments. What is the remedies have per assessee? There may be firstly assessing officer when he is making adjustments. What he made adjustments, he will not allow the deductions related to chapter 6a deductions is not allowed, and section 10 AA deduction is not allowed, and when any corresponding adjustments would not be required for other associated persons. This is the adjustments will made by the assessing officer. What can the assessee can do? Assessee can, if he is a person eligible under section 144C, he can make appeal. He can make to appeal against the order passed by the assessing officer, and appeal can be filed to appellate authority and appellate tribunal, income tax appellate tribunal, to the commissioner as per section 246A. And if he want to go for appeal, he can go. If he don't want to go for appeal, he will revise the order. He can file a revision of order of assessing officer under section 264 within 1 year from the date of order sought to be revised communicated. This is the two options is there. You will go for appeal and you will file for application of revised order. So what is there in answer? In case of assessing officer makes adjustments, so he is making adjustments and to arm's length price. So in case of international transactions, we should follow the arm's length price for all international transactions. What is meant by all international transactions? When there is a person, one person is a resident and another person is non-resident. This is the case. It will be treated as international transactions. And where is a both are non-resident persons, it is also international transactions. Both are resident persons, it is not a residential non-resident international transactions. Okay, see consequences. No deductions will be allowed under section 10AA. Chapter 6A shall not be allowed. So no deduction 10AA deductions is not allowed. Chapter 6A deductions is not allowed for income. So income will be increased. What is happen if the income is decreased? It will not be adjusted. So if the income is decreased, no options is there, you will not reduce any tax. Next, no corresponding adjustment. So here income is increased income is increased means other person's expenditure is increased you will not adjust any adjustment. So no corresponding adjustment to the total income of other associated. It will not be allowed to other associated persons to adjust it expenses. What is the income he is paying that income is not allowed to other person's expenditure. Next, remedies. What is the remedies is there? In the case of assessee, he is eligible under section 144C. If he is a eligible person, and he can file objection within 30 days from receipt of draft order by him from DRP, that is Dispute Resolution Panel, and assessing officer, and appeal can be against the assessing officer in pursuance of directions of DRP. DRP will provide the direction to file the appeal against the assessing officer and made to the income tax appellate tribunal. And any other case, he can file appeal under section 246A commissioner appeals, that is against the assessing officer within 30 days. So he will file within 30 days from the date of service of notice of demand. And he can opt for application of revision of order of the assessing officer under section 264 within 1 year from the date of which order sought to be revised communicated, provided the time limit of appeal of commissioner or income tax appellate tribunal has expired. So are the assessee waived to the right to appeal. So here three options is there. So he can go for income tax appellate tribunal, and he can go for commissioner appeals, and he can go for revision order. Next, second case. In second case, what is provided in second case? One company is there, that is I limited is there, and supplied the company to its holding company. So it is supplied, holding company is u limited. It is Indian company, it is holding non-resident company. So when there is a resident and non-resident, it will be international transactions, it will applicable transfer pricing when both are associated person. So holding company associated persons means it will be associated enterprise. That is, two conditions was satisfied. Next, what is there in a question? That is provided that limited also supplied some products to unreserved. See, it is uncontrollable persons, uncontrollable related persons. He is controllable persons. Next, based on V limited and unrelated entity, the transaction with U limited as priced 500 rupees per MT FOB basis, whereas transaction with V limited are priced at 700. So for related party, we have transaction with 500 rupees. From outsider, we are transaction with 700. They provided freight, so they will deduct the freight. So what is the freight? 200 rupees. So 700 minus 200 rupees, it will 700 minus 200 rupees, it will become 500 rupees. So we are also charging same 500 rupees. So it is not a case, because we are following the ALP. Because see, answer in this case, I limited, the Indian company, supplied billet to its foreign holding company. Since foreign company U limited his holding company, I limited and U limited has associated enterprise with the meaning of 92A. So there is an international transaction, they both are associated enterprises. Next, I limited supplies similar product to unrelated entity. We limited UK transactions. The between these two persons, we will see the uncontrolled transactions. So comparable price, we will see the related person and unrelated person. So for the purpose of determining ALP, arm's length price of transaction between associated enterprises, this is called as cup method. That is comparable uncontrolled price. So from uncontrollable person, we will see the its price, and we will compare this. Next, determination of ALP, which is applicable. Next, transaction with U limited on FOB, whereas transaction with V limited on CIF, the difference adjustment become comparing the prices. So what is their price was provided? 700 rupees provided, and they are charging for freight, and we will deduct, and it will become 500 rupees for adjusted price. And we also fixed, let's say, adjusted price V limited UK and price fixed for U limited are the same. Arm's length price is U 500. Since sale price to related party and unrelated party is same, transaction with related party are also carried out arm's length price. Next, question number 3. What is there in question number 3? And we will see that X limited is there. Okay. He is operating in India. He is a Indian person. Okay. Next, dealer of goods manufactured by N limited, and here one company is there. This is company, Japan company, and N limited holds 50%, 55%. So 55% is visible, that is more than 26%. He is become associated enterprise, and this one person is resident, one person is not resident, but it is international transaction. So ALP will be applicable here. Okay. Next, 55% of share, and out of 7 directors of company, 4 are appointed, and one another condition is also satisfied, that where that persons, if appointing persons is more than what is there. If it is a 7 members, it is required 4, then it will be both treated as associated enterprise. If it is a 5 and it will be 3 persons is appointed by that person, then it will be treated as associated enterprises. Now they were appointed more than existing. Assessing officer, after verification of international transactions of 300 lakhs for the relevant year, by noticing the notice field has maintained to requisite documents and also not obtained the account report, adjusted its income by making additions. So assessing officer provided the notice to that person declared, and also issued show cause notice to levy various penalties, seeking your expert opinion. So we need to provide the expert opinion. So whatever the assessing officer done is correct, because he is not maintaining the records books of accounts. When the books of accounts is not maintained, we will pay the penalty. What is the penalties is there? Penalties will be like this. If you fail to report any transaction, and so that you are not paid the tax, so now you will pay the tax at the rate of 200%, whatever the tax is there. For example, your tax is 50 rupees, now you will to pay 200 rupees. So now you will pay 200 rupees. That is first case. And second one, you are not maintain the records. No. So for that transaction, whatever the transaction you have done, the 10 transaction or you have done the 20 transactions, whatever the transaction you have done, take that transaction, and for transaction you will pay the on value 2% as penalty. And third one, if accountant, that is chartered accountant, is required to file his return within 30 November, that is within due date. If he has not furnished the return, then liable to pay at the rate of 1 lakh. So this is the 3 penalties is there. Now we will see the answer. The fact of the case indicated that X Limited and N Limited Japan Associated Enterprises, it holds 55% and it, so just a minute, and it has what happened, man? And it has appointed more than board of directors, because there is 7 members there, 4 was appointed this person. So both are, X is resident, Y is non-resident. Any transaction between X and Y falls under the meaning of international transactions under section 92B. 92B discussed about international transactions, and 92A discussed about associated enterprises. Associated enterprise means there are some transactions is there. If your transactions is applicable to you both are become associated enterprise. Next, what is there in when associated enterprises is there, international transactions is there, then the transactions, the income arising will be computed as per arm's length price. And next, actions of assessing officer in addition to the declared income and issuing so-called notice for levy of various penalty is correct, because default, X Limited is defaulted because he is not maintain the books of account. When you are not maintaining the proper books of account, you will liable to pay the penalty. Next, what is the penalty is there? Penalties will be like this: failure to report any transaction, any international transaction, or any transaction, or deemed to an international transaction, or any specified domestic transactions. Whatever the transactions is happened, you are liable to pay tax, but you have not paid the tax. So now you will to pay the, to which that provision chapter 10 is would applicable penalty will be 200 rupees of payment of tax payable. So then whenever the transaction is happened, you are required to pay the tax. Then you are not pay the tax, no, now pay the tax at the rate of 200%. So whatever the tax is there, you are required to pay. Next, where the since payable, it is misreporting of incomes. Next, failure to maintain records. So you are required to maintain books of accounts. Based on that maintaining, you are required to pay the tax, but you are not maintaining the books of accounts. So for the books of accounts is not maintaining, you are liable to pay the interest at the rate of 2% on value of each transaction identified. Each transaction, in first case it will be tax, and second case it will be value on each transaction, and third case it will be the report related and accountant, it will be penalty. Fixed penalty will be 1 lakh. Understand? Okay. Next, the assessing officer, before issuing any notice, there must provide the opportunity of being heard must be provided. To why arm's length price should not be determined on basis of material or information or document in the possession of assessing officer. And here we will see, if he is not maintaining ALP, because of there is an agreement between assessee and assessing officer. That agreement may be a APA agreement, or it may be a safe harbor rules. If you are after this agreements, then you are not required to pay, you are not required to maintain ALP cases. Next, fourth question. What is there in fourth question? In fourth question, they provided that Anusha Motors is there. Okay, Anusha Motors is there, an Indian company. It is a Indian company, and declared income will be 300 crores. And with chapter 6, so it has provided income will be 300 crores. Okay, next. But before making any adjustment in respect to the following transaction, so there is some transaction it has not maintained the records, proper records. Next, okay, what is there? 100 cars sold to Rida Limited, US company, which is hold 30%. 30% means more than 26%. So it is associated enterprise and it is non-resident person. It will become it is required to maintain ALP, and they are not maintain the ALP because they are less by 200 rupees is there. So when the sale is happen, you are pay less amount. So now we will add back that amount, whatever the amount is there, 200 rupees each and 10,000 cards. So 10k into 10k into 200 into, and it will be the dollars, and we will convert it to rupees because it will be rupees, and whatever the rate is there we will see later. And next, the amount royalty was paid 120 lakhs was paid to K2 US company and technical know-how manufacturing company. However, K2 has provided same know-how 90 lakhs. So we are showing more expenditure in our books. Because of that expenditure, our profit was decreased. So I will need to increase my profit. What amount is need to provide? 120 minus 90. It will be 30 lakhs. 30 lakhs will be dollar. It will be converted into rupees. Next, third one will be loan of euro 1000 crores carrying interest at the rate of 10%, and Germany company was outstanding. The total book value will be amount of Anusha Limited, and here the person when the loans was taken, our books of account, we will see how much percentage of loan was taken. If the specified percentage is exceed, then it will be treated as associated enterprise. So if both are associated enterprises, then if different is there, so they have paid more expenditure, so our profit was decreased. So that we will add back that 1% case. So 1000 into 1% into whatever the rate was provided. Here the euros was used, so euro rate was used. So rates will be required for now, so they provided rates here. Okay, any income from an international transaction when two or more associated enterprises enter into mutual agreement or arrangement shall be computed as arm's length price in provisions of chapter 10. So section 92A, what is defined in 92A will be discussed about associated enterprise. 92B will be discussed about international transactions. So 92A, what is the 92A? When two enterprises shall be deemed to be associated enterprise when the sections is applicable A to M. 92A to M, there is some transactions was provided in that section. Next, Anusha Motors is associated with, so first case, when more than 26% is there, it will be treated as associated enterprise. So Rida Limited has per 92A because this company holds sharing more than 26% of voting power in Anusha Motors. Next, K2 has per section 92 since he is a sole owner who is working for our company, then it will be treated as associated enterprise. Next, draft, when case of loan financing given our more than book value, more than 51% of book value, the loan was there from other person, it will be treated as both are associated enterprise. So both are satisfied in our cases. So we will add back all three. So we are add backing. So see, and 200 into 10,000 into 63 into 63, 30 lakhs into 63, and here it will be 84 rupees. That is euro case, this one. So we will add back all. For example, if there is any, they are charged more. We will deduct anyone? No. This is wrong. We will not decrease the income. If it is a case of decreasing the income, we will assessing officer will not come there. Next, the difference of excess payment of royalty has been added back, presuming that manufacture of cars by Anusha Motors is wholly dependent on use of novel owned by the Koto. limited. Next, if here we will follow the ALP when there is no agreement between advanced pricing agreement or safe harbor rules not opted. Next question will be, what is the legislative objective of bringing into existence the provisions related to transfer price in relation to international transactions? What is the legal objective here? There legal objective is simple. Because of this they are doing transactions and they are showing more expenditure from their related parties, they are benefiting, and our Indian will be decreasing the profit. They are paying less tax. This is tax evasion. So for this tax evasion, and our revenue was decreasing. Because of our revenue was decreasing and there is no reasonable for that, and there is no fair transaction will be happening, and we will make this international transactions for the purpose of to lead this multinational enterprise. So we will see the answer. The presence of multinational enterprise in India and their ability to allocate profit in different jurisdictions by controlling the prices. So what is they do? Controlling the profit for intra-group transactions. They will not control the profit for unrelated person. They will control only when there is a intra-group transactions prompted by government to set up an expert group. For this purpose, they have set up the expert group to examine the issues relating to transfer pricing, and there is ability two or more entities belonging the same multinational group of fix up price goods or services and allocate profit among enterprise within group in such a way that there may be either no profit, so they will show no profit, or they will show negligible profit. For that they will pay the tax amount. For example, you are an Indian company, your actual profit is 100 crores and we will show more expenditure and profit will be become 2 crores or 1 crore, and we will not pay the tax. Next, for this reason, the increasing participation of multinational group in economic activities. Nowadays, international transactions, nowadays multinational companies are investing in our company in India, giving rise to new and complex issues. So this is complexing issues. So for these complexing issues, multinational companies profit derived from such enterprise carrying on business in India can be controlled by multinational groups. So controlled by multinational groups by manipulating prices charged. So whatever they are charging, they are manipulating, and whatever they are paying, they are manipulating. It leads to erosion of tax. What is happening? Erosion of tax revenue for our India. Therefore, transfer pricing provisions has been brought by Finance Act 2001. For 2001 it was acted. Next, with a new view to provide statutory framework to lead computation will be reasonable and fair and equitable profit and make tax in India in case of multinational transactions. Next, question number 6. What is there in question number 6? In question number 6 we will see here XE Limited is there Indian company, and Jilla Incorporated is USA company, and voting will be 28%. It will become associated enterprises because 26% greater than 26% is there. Next, following transaction is there between these two companies. What is the transaction is there? And when both are associated enterprise, we will follow the ALP. Next, XE Limited sold 1 lakh pieces of t-shirts at 2 rupees per t-shirt to Jilla Incorporation. So he is selling. When selling, if he sell for less than price, we will add back. Because of that, if he charge less amount, our income was decreased. So what is the rate? He has charged 2 rupees, but it is actually 3 rupees to unrelated person. So 1 rupee will be added. 1 lakh into 1 rupee into, and it will be the case of dollar. We will convert into rupees. Rupee rate we will need. Next, X Limited borrow 2 lakhs from when the borrowings, and if interest is paying, more interest is paid means our expenditure was decreased and profit was increased. So we will add back that expenditure now. So from company, he has paid 10,000 as guarantee fee to Jilla, and if we paid to unregistered person 7,000. So actually they will pay 7,000, but they are paid 10,000 more. 3000 will be added. 3000 into whatever the rate was provided, we will add back. Next, X Limited paid 15,000 to Jilla Incorporation, getting various potential customer detail to improve its business. Jilla Incorporation provides same services to unrelated party 10,000 rupees. So they are paid. Paid means our expenditure was increased, profit was decreased. So we will add back that amount of 5,000 into whatever the rate is there. We will add back. What rate was 64 into 64 into 64 into 64. Next, XE Limited is located in special economic zone. When you are associated enterprise, then no deductions will be allowed to section. Here we will take section 10AA and chapter 6A deductions. Chapter 6A deductions is not allowed. This is the case, and we will see the answer. For the answer, they provided that XC Limited, an Indian company, and Jilla Incorporation, the US company, deemed to be associated enterprise. Why they are associated? Because not less than 26% is voting power in XC Limited. Next, as per section 92B, 92A will be associated enterprise, 92B will be transaction, international transaction. What is meant by transaction? International transaction. International transactions means when transaction entered between two companies for sale of product, lending, guarantee, provision of services relating to market research, and includes international transactions. So it will also include international transactions, and accordingly transfer price would be attracted, and income arising from such international transactions have been computed in arm's length price. And in this case, from information given, arm's length price has been determined using comparable uncontrolled method, that is cup method. Why we will go for cup method? Because unrelated person price is given, and we will from that unrelated price we will compare from our person. So we are comparing unrelated price. So cup method, appropriate method. And amount by which total income of XC Limited is enhanced on account of adjustment in the value of international transaction. What is the difference? Is there 3 minus 2, that is 1 rupee into 1 lakh into 64 rupees is the rate. And what is the excess amount we have paid? 3000 is paid. So we will add back 3000 into 64 rupees. And whatever the excess payment was paid for services, 5000 into 64 rupees, and it will become 69.12, and he cannot claim the deduction under section 10AA 69.12, being amount of income by which total income is enhanced by virtue of first provision to section 92C4. Next, question number 7. Examine with reasons whether the two enterprises referred to in the independent situations. So what we are required, they are provided, they are associated enterprises, they are entered some transactions. It will come under transfer pricing regulations or not, we will discuss. So first we will see PQR incorporation. There are some transactions, if they are associated enterprises, or we will provide. Two enterprises was provided for independent transactions. Below can be deemed to be associated enterprise under Indian transfer pricing regulations. So we will see regulations. As per regulations, for transactions is there, then it will be treated as associated enterprise. Next we will see that PQR incorporation. So one company is there, P company, and Poem was there also in Poem in USA company, and it was advanced loan to Mahanandi Limited. It is Indian company, and on 1/10/4/2021, where book value of assets will be 300 crores. So 170 was there. 170 was paid and 300 is book value, so more than 51%. That is, if you given 150, it will become 50%. So more than 51% of book value was there by associated enterprise value, so it will be associated enterprises. Next, the market value of assets however is 320 crores, and Mahanandi Limited repaid 30 crores before 31st. Why? Even though he has repaid, it will not impact. So when the loan was taken, it was more than 51%. So that more than 51% is there in book value, it will be treated as associated enterprise. Next case, Q company is there. What is there? Q company is there. Okay, what is doing Q company? French company. It is French company, and Poem will be in power to appoint two persons, and out of 8%, sorry 3% out of 8%. When 8 is there and we require for appointing more, then it will be treated as associated persons. If your appointment power is less than this, then it will not be treated as associated enterprise. So less than half of is there, so it will not be associated enterprise, not associated enterprise. Next, total value of loan. Total value of raw materials and consumables of Saraswati Limited Indian company is 90 crores. So Indian company has taken 900 crores. He has purchased from supplier tune of 830 crores from Germany company, which is poem he is there 8 and 830 rupees. So both one person, Joel is Germany company, and he has supplied this company for Saraswati. Out of Saraswati is purchasing more from other than person, so it was exceeded 90% specified percentage, then it will be treated as associated enterprises. Associated, if you are purchasing from one company for that outside country and more raw materials is purchased from that person only, then it will be treated as associated enterprises. Next, here we will see the answers. Now the answer will be, first one answer will be PQR is a foreign company and advanced loan 170 crores to Mahanandi Limited, and we will 170 crores divided by book value will be, what is the book value was provided, 300 crores. So it will become 56.67%, that is more than 51%. More than 51%. Since the loan advanced by PQR is 51% or more of Mahanandi, PQR and Mahanandi are deemed associated enterprise in Indian transfer pricing regulations. Next, the deeming provisions would be attracted even if there is repayment even if the repayment of loan during the same previous year, which bring down the same percentage below 51%. We will see the percentage at starting, not at ending. Next, second, what is there in second? In second, they appointed 3% out of 8%, so it will become 37.5%. so their power has only 37.5%, but we required for, if you want to two enterprise deemed to be associated enterprise, we required more than half of the board of directors of one enterprise are appointed by other enterprises. When more than half is appointed by another person, then both are treated as associated enterprises. Next, in this case, since Q Land PLC has power to appoint only 37.5, it will less than half, it will not be treated as associated enterprise, not deemed to be associated enterprise. Next, since Joel is German company supplies 92.2% of raw materials consumables required by Saraswati is Indian company, more than 90% was purchased from single supplier, that to other country person, so both are treated as deemed associated enterprise. Next, question number 8. In question number 8, what is provided? Here we will see NP 1P is there, borrowed 80 crores. So when it is a borrowing, we will see the book value 50% or more for book value, then it will be treated as associated enterprise. So the company incorporated in India, from it is taken from other country person and interest rate was 10%. Okay, and the said loan is repayable over period of 5 years. Further, loan is guaranteed by ST Incorporated in UK, Mrs. Feed Incorporation non-resident, who is holding 40% of voting power, so more than 26%. So both are associated enterprises. Next, here they provided that when there is a associated enterprise, guarantees is given, and then we will charge the interest. How much charge interest is allowable as deduction will be actual interest, whatever the interest is paid, or 30% of EBI DTA, I think so, EBT DTA, whatever the ending before interest depreciation tax. EBITDA it will become, I think so, 30%. Whichever is low will be allowed as deduction in case of interest is there. So if an Indian company being a borrower incurs any expenditure by way of interest in respect of any debt issued by non-resident associated enterprises, and such interest exceeds 1 crore, if the exceeds 1 crore is exceeded, this year 80 crores into 10% it will become 8 crores. So 1 crore was exceeded, and they provided another information here. We are not seeing now. This is 7 crores after debiting the above interest, depreciation 8 crores and income tax 4 crores. So for 7 we will add back 80 crores into 10%, 8 crores plus 6 crores we will add back, and 4 crores we will add back. 4 plus 4 plus 6 10, 10 plus 8 18 we will add back to this one, and we will get one amount. From that amount we will see the 30%, and if the amount is more than this 8 crores we will provide this one. If it is less than, and we will provide this one 30% case. And here they provided the C, interest is exceeded 1% when interest paid, that is 8 crores, are payable of such company in excess of 30% of earning before tax, depreciation, amortization, or interest paid are payable associated enterprise, whichever is lower, that is actual amount, or 30% of EBITDA. Next, 92 will be allowed as deduction. It will be allowed as deduction. Next, further, where debt is issued by lender which is not associated enterprise but an associated enterprise, either by providing implicit or explicit guarantees to such lender, or deposits or corresponding and matching amount of fund which the lender and debt shall be deemed to have been issued by an associated enterprise. There may be relationship, associated enterprise relationship will be direct or indirect. Interest will be allowed as deduction. What amount is allowed? Only the actual amount, or 30% of EBITDA. Next, here in the present case, since T Limited holds 40%, so more than 26% voting power, so both are NP and ST will become deemed associated enterprise, and ST Incorporated deemed to be associated enterprise. Here the loan was taken 80 crores, okay, 80 crores Indian company from guaranteed by ST associated enterprise. Since debt deemed to have been issued by an associated enterprise, and interest is payable and allowed as deduction as per section 94B, that is actual or 30% of EBITDA. Next, we will see 80 crores will be the loan amount, 10% will be the interest rate. So net profit was provided, and we will back this, and interest will be added back, and depreciation added back, income tax added back. We will get the EBITDA 25 crores. 25 crores into what is the percentage? 30%. Total interest paid are payable in excess of 30%. What amount he is paid? We will see 30% on that amount, 30%, and EBITDA 8 crores minus 7.5 crores, 50 lakhs. It will become interest paid are payable to non-resident associated enterprise will be 8 crores. So deduction will be allowed 50 lakhs. Deduction will be interest to be disallowed. Disallowed will be 50 lakhs. So only up to the 30%. 30% will be allowed as deduction. Above 30% it will be disallowed. 30% up to 30% will be allowed as deductions. Next, question number completed here.